Welcome to another Smart Money Concepts video. According to the latest data by American analytics company Gallup, about 58% of Americans own stocks. This saw a 2% increase from 2021's 56%. That means more than half of the population invested their money in the stock market. If you're part of this group, good for you. I know you've already educated yourself on the do's and don'ts of investing. But if you still haven't invested, I have something to tell you. Do it now. Do it during a recession for the best gains. To be clear, this is not financial advice, just an educational overview of how generational wealth is built in down markets. So sit tight. Investing has long been considered one of the most effective ways to build wealth, and you don't need to have millions of dollars in your account to do it. Even if you're not rich, you can still open an investment account. Some providers don't even require a minimum amount to open an account. The best time to invest is actually 5 years ago, but the next best time is now. Imagine if you've invested $100 each month for the last 5 years with a promising return of, let's say, 7%. You have about $7,301 today. You've made money just by having money. Now, you're probably wondering how your $1,000 can grow just by investing. I know you have so many questions about investing right now, and I'll try to answer them all throughout this video. But before we start, please don't forget to hit the subscribe button for more Smart Money Concepts videos. This year, with talks of an impending economic slump happening, it's important to be really careful with decisions that involve your hard-earned money. Right now, there are lots of investment options, and if you're a starter, you may find it a little confusing as to where you should put your money. Saving versus investing. Opening a savings account. This is probably one of the simplest ways to store your money and overall a good start to learning more about earning interest and saving your money. I recommend that you open a savings account right now because the interest rates for savings have finally gone up after the recent rate hike by the Federal Reserves. Listen, having basic savings is good, especially now that the market is unpredictable. It's good to have a stash of cash for emergency purposes. It may not seem like much, but it's better than nothing. Investing. But there's actually a thin line between saving and investing, and it lies in the word risk. Investing comes with risks. Here's the thing. Risks come with rewards, and sometimes they come in hefty amounts. That's what you won't get with saving. Simply saving your money won't promise you big returns, but you can be assured that your money is safe. Of course, you have to consider a lot of things before you put your money into something. Do you have an emergency fund in case things don't go your way? How much risk can your money take once you start investing? Because nobody knows what will happen in the market in the future, and potential rewards might topple and become potential losses. How to invest. Putting your money in stocks and funds means purchasing shares of companies and businesses. You now own a slice of that company, and once it thrives and flourishes, your stocks become more valuable, and other people or investors would want to buy them. It's totally up to you if you want to sell them or not. Truth is, with investing money, you have to invest your time too. The market is always fluctuating, but don't be surprised because this is normal. To start investing in stocks, it's helpful if you decide on your strategy. You may open an online investment account that will be used solely for investing in stocks, and there are also a lot of brokers out there who will help you as you tread the investing route. Decide your investing strategy. To effectively invest your $1,000, you can choose from a myriad of options. You may choose to do it yourself, hire an expert, or even invest in your employer's 401k. If you choose to hire an expert, you have to disclose to them your specific goals and expectations so they can help you manage your investments. You can search for brokers and independent advisors online and carefully look for someone who thinks the same as you. But be forewarned that managing brokers charge hefty fees, and it is possible to give away your profits in the long run. You may also choose to invest in your company's 401k. I'm pretty sure you'd get the hang of investing just by doing this. This is one of the first investments taken by starters because it makes you familiar with the investing routine, putting in little contributions regularly while thinking long term. Here's an awesome tip from our Smart Money Concepts investors. Make an appointment to speak with someone in your company's retirement department and ask if they have a 401k matching program. If the answer is yes, then you should consider getting into that program now and also consider applying the maximum towards it. Here's how it works. A 401k match is money that your employer contributes to your 401k account. For each dollar you save in your 401k, your employer wholly or partially matches your contribution up to a certain percentage of your salary. Nothing like free money, right? Self-directed investing. For DIY investors, self-directed investing allows you to trade stocks, mutual funds, exchange-traded funds or ETFs, and options yourself directly online at brokerages such as Vanguard, Robinhood, Webull, E-Trade, Fidelity, and the likes. If you decide to invest on your own, then you can start opening your brokerage account. This type of investment account is perfect for those who would want to save because this is very similar to a bank account, except it allows you to enter the stock market. This is also the most affordable way to purchase stocks and funds, especially since you'll be managing your account yourself. Want to know the best ways to invest your money? We got you. Don't forget to hit the subscribe button and the notification bell to get notified whenever Smart Money Concepts posts a new video. Investing in stocks versus funds. Now that you've opened your own account, you might wonder what's the difference between individual stocks, stock mutual funds, and even exchange-traded funds or ETFs. Individual stocks. Stocks are shares owned by an investor which reflect his or her fraction of ownership in the total assets of a single corporation. So, if you start to invest in a particular company, let's say Microsoft Incorporated, then that means you're buying stocks from them. Listen, it's of utmost importance that you research really well into the company that you would want to put your money into. Investing in individual stocks has its own pros and cons, and you have to know this so you'll be prepared in case your chosen company experiences losses at certain times. Stock mutual funds. This type of fund is a collection of money merged from a number of investors, which is then invested in a portfolio of assets. So, when you invest in stock mutual funds, you also possess small shares from different companies and firms. Mutual funds allow you to buy different stocks in one go. Stock mutual funds diversify your portfolio, which leads to lesser risks and seemingly higher returns. Exchange-traded funds. You probably heard or read this when you first started researching investing. An ETF is quite similar to a mutual fund as it's also a pool of money invested in a portfolio of assets. However, ETFs are traded like stocks. They can be purchased and traded throughout the day at different and unpredicted prices. It's also less expensive and offers more transparency than mutual funds. These different types of investments all have their own set of risks, and you can choose from them or even all of them, depending on your preferences. But remember, it's great to have a diversified portfolio, especially at times like this, so that you can minimize your chances of experiencing risks. How much should you invest? Is your $1,000 enough? Yes, of course, your $1,000 can go a long way, as long as you invest it ASAP. If you want to invest in individual stocks, then you must know that the amount depends on the prices of the shares. They can be as low as a few $100s to thousands of dollars. Moreover, mutual funds usually require a minimum of $1,000 for you to have a chance to invest in them. But ETFs are traded like individual stocks, so you can buy them at a share price, which again can be as low as a few $100s. So the good news is, your $1,000 can lay the groundwork for your money-building journey. Where to invest your money. Now that you've gathered the courage to invest your money, here are a few beginner investment options to choose from. Number 1. Invest in an individual retirement account, or IRA. An IRA is an investment account that helps an individual save for his or her retirement. There are two types, Roth IRAs and traditional IRAs. Their main difference is the time when they allow you to have tax breaks. A traditional IRA is tax deductible and your money is tax deferred as it grows, but withdrawals after the age of 59 and a half are taxed the same as your present income. On the other hand, a Roth IRA offers no tax deduction on your money, but it makes your withdrawals after age 59 and a half tax and penalty free. For starters, you can open any type of IRA, but of course, it differs depending on your estimated earnings during your retirement age. If you think your income now will probably be the same or lower in the future, then a traditional IRA is the better choice. But if you think that your income will be significantly higher by then, it's best if you acquire a Roth IRA. Before deciding where you'd invest your money, don't forget to hit that subscribe button and the notification bell to get notified whenever Smart Money Concepts posts a new video. Number 2. Start a taxable investment account. As I mentioned earlier, a taxable brokerage account allows you to enter the stock market, and it's just like savings accounts but with higher returns for your money. But you have to remember that you need to deposit in your brokerage account every now and then. Think creating a recurring monthly or quarterly deposit schedule so that later on you can reap the actual fruits from your investments. Number 3. Find a robo-advisor. You can use a robo-advisor to help you achieve your financial goals. Robo-advisors are online investment platforms that trade your money using algorithms and questionnaire responses. They can provide you with services like managing your portfolio and arranging your financial plan, and most of them don't require a minimum. Currently, there are a lot of robo-advisors online. Examples of this are Acorns and Asset Builder, which you can use at a lower price compared to actual fund managers. You can search for them online to see who can best give you the service that you're looking for. Number 4. Invest in an ETF. Much like mutual funds, but at a significantly lower price, an ETF is one of the best ways to start your investment journey using your $1,000. They are generally passive and gives you tons of choices for you to diversify your portfolio. They're easy to buy and often require less fees than mutual funds. You can choose to use your $1,000 to find exchange-traded funds which have different risk profiles and that resonate with you. Number 5. Choose a company and invest in it. Yes, you can use your $1,000 to buy individual stocks from certain companies, but you have to remember that this is a commitment. Own stocks with the intent of staying with a company for a long time, as that is when you'll get the most out of it. Individual stocks provide you with that sense of ownership and control over your investments. But in Warren Buffett's words, you need to truly believe in the company's potential long-term growth before choosing to invest in individual stocks. You need to know that there are lots of complex strategies and approaches to be successful in this. Remember to do your research on the businesses you'd like to invest in, and always prepare for the unexpected, sudden rises, and hasty fluctuations. I have a tip for you once you start investing. You shouldn't constantly check your investments. Stressing yourself out when you see the rapid rises and falls won't do you any good. It's good to look at them every once in a while to get a glimpse of how they're doing, but remember that the market is volatile, and there's no guarantee that you'll see what you expected to have. Remember, investing isn't a shortcut to generating wealth. In fact, it takes time, knowledge, and a lot of perseverance for you to be successful in this journey. I hope this video helped you decide where to put your hard-earned money. Do you have some insights on our topic today? Comment it down below. Just click the like and subscribe buttons now to make sure that you don't miss our next video.